Alright, we just finished going through Texas Instruments fiscal 2026 second quarter earnings call materials, and now we want to share what we're taking away. Let me start by poking a little fun at the market here. T walks in, beats on revenue, beats on earnings. Post numbers most companies would pop champagne over, and the stock gets sold off. The crowd spent all year screaming this was the great semiconductor comeback, then threw a tantrum the moment the comeback actually showed up. Funny, right? Alright, let's drop the jokes and figure out what really happened here. So here's the paradox, and honestly the market kind of set itself up for this one. The company posted revenue of $546 billion, up 23%, 4% with adjusted earnings of 2.9 and 85% beat on the street's number. Go ahead, try to tell me that's a bad quarter. You can't do it. And yet the filing shows the stock fell 3.06 cents after hours, and the bulls will scream that's unfair. They beat and got punished. But hold on, look at the other pan of the scale. The shares were already up 70% year to date walking into this print. When you've run that hot, a beat isn't a surprise anymore. It's just the rent you owe. Our take, they didn't sell a bad business. They sold a stock that already priced in every bit of the good news. The real question the material teases is whether this recovery lasts and whether all that capacity turns into actual market share. Before we go further, let me set the table, because you can't judge the quarter without knowing what they actually sell. The material calls analog chips the salt and pepper of silicon, sprinkled into every car, every server, every gadget you own. Power management, signal conversion, embedded controllers, thousands of unglamorous little parts, and nothing electronic runs without them. The business logic the deck spells out: extreme variety, low cost per chip, and monstrous volume per device. Now here's the part the hype crowd actually gets right. The moat comes down to two things. One, the company points to 300mm internal fab capacity, so it owns its own supply instead of renting a foundries. Two, an 800V high voltage architecture that drives exponential content growth per unit. Tuck that second one away, we'll circle right back, because our read is that's where the real long game lives. Simple mental picture: the fancier the machine, the more TI silicon is quietly hiding inside it. Okay, let's throw the quarter up on the terminal, because I want to be fair after ribbing that beat. This was not one hero product line carrying the whole team. The company reported gross margin of 61%, up 340 basis points sequentially, and operating margin of 42%, up 48% year over year. That operating leverage, that's the number that shuts me up and makes me lean in. Revenue was that $5.46 billion, up 23% year over year and 13% sequentially, so it's speeding up, not just healing. One honest asterisk: adjusted earnings of 2.099 include 5 cents from a one-time tax benefit, so back that out before anyone brags. Both engines ran. The filing shows analog up 26% and embedded up 16% year over year. When the whole company fires at once like that, I'll drop the sarcasm. That's a genuine resurgence. Our take, the breadth, is the real story here, way more than the headline beat everybody obsesses over. Now here's where I get suspicious, because a margin like that always makes me ask, how'd you really do it? And to their credit, the material doesn't dodge. It says factory utilization, not pricing. Picture a plant with idle lines. Flip those machines back on, and every extra unit is almost pure profit. That's operating leverage, plain and simple. Management confirms pricing in the first and second quarter was strictly flat, so nobody juiced these numbers with hikes. And here's the receipt that it's honest. The deck shows inventory drained to 196 days, down 13 days on the quarter, on 4.6 billion of total stock. Think about it, if they were stuffing the channel to fake a beat, inventory would swell, not shrink. So the core insight is clean. They turned the machines on and genuinely sold the product through. That's the real deal. And I'll put myself at 80% that this particular margin story holds up. Alright, the company says the strength is broad, so let's kick the tires market by market. The filing shows industrial up 30% year over year and 10% sequentially, a broad recovery led by energy infrastructure and test and measurement. Data center is the show-off of the group, up 100% year over year, a straight up doubling in volume. Automotive grew 13 to 16%, an inflection the company pins on China and on EV and hybrid demand. And then personal electronics, flat as a pancake, choked by component shortages. So 4 markets, 3 of them ripping, so one going absolutely nowhere. The CEO's line, quote, "This is the start of a very broad cycle," unquote. And you know what, I'll give the bulls this, 3 or 4 firing generally does back that up. That's not spin. But our take, don't ignore that flat consumer bucket. A cycle that's truly broad eventually needs the last guy off the bench too. Here's where I want to cool the party down a little, because a giant year-over-year number can absolutely fool you. The material draws industrial demand as a mountain, and the punchline is that we're only halfway up it. The deck marks the current quarter still 5 to 6% below the 2022 peak, way off the top but climbing out of a real cyclical trough. And oddly, being below the peak is actually the good news here. Let me explain why. The call-out says clients aren't panic restocking, they're burning down old inventory and ordering next-generation systems instead. Do the math. If everyone were hoarding to beat shortages, you'd brace for a fake spike that collapses next year. Instead, the materials verdict is a real recovery, not false over-ordering. Our read agrees, slow and real beats fast and hollow every single time. That gap back to 2022 isn't a red flag, it's runway, as long as they keep grinding up the hill. Now let me hand you the single best slide in this deck, cause even a skeptic tips his hat right here. The material puts competitor lead times at 52 weeks against TI's 13 weeks. Read that again, a full year versus 1 quarter. That's not a gap, that's a canyon. The company says it spent heavily last cycle to get its 300 dummy internal fab structurally ready for 3 years out, and now that boring, unsexy capex is cashing in. The result the filing describes. They're grabbing emergency orders from clients whose production lines got paralyzed waiting on competitors. Management's line is slick, quote, "Our plan is not to be the problem, but to be the solution," unquote. But here's my needle, and the bears would jab the same spot. A panic order is not a loyal customer. The real question, and we'll flag it again, is whether those desperate buyers stay once competitor supply finally heals. The moat is real today, no argument, but the durability of it is still the open bet. Let's talk pricing, because this is exactly where the hype crowd front runs itself and gets burned. The material frames it as a slow boil in 3 stages, and patience is the entire game. Stage 1, the first half of the year, price is held dead flat, and the deck calls that a real win against an industry that usually bleeds price every single year. Stage 2 this quarter, hikes are just starting, client by client, mostly analog, but the company flat out admits the dollar contribution right now is negligible. Stage 3, late this year into 2027, that's when the actual margin payoff from pricing power is supposed to land. So the bottom line, the material draws, management played expectations like a fiddle, selling pricing as a slow burn, not a firecracker. Our take, do not pencil a pricing windfall into next quarter. This is a 2027 story. And 2027 is a long, long way to sit holding your conviction, so size the position for that. Remember that 800V teaser. Here's the payoff, and I'll admit it, it's genuinely slick engineering. The material shows a step down chain, 800 volts in, knocked down to 48 volts, then down again to 12 to run the actual hardware. The thesis? Every single one of those conversion steps forces the box to cram in more tie power management and signal chips. So pushing a data center to 800 volts literally multiplies TI content inside every rack. More steps, more chips, more dollars. Beautiful story, and I completely get why it lights people up. But here's the cold water the deck pours on its own idea, and it matters. Management explicitly declined to guide that 40 to 50% long-term growth number. So file this as a thematic catalyst, not a signed contract, and that's a big difference. Our honest read, the physics is sound, but a story you can't yet slap a number on is a story, not a model, and the market keeps forgetting that. Okay, this is my favorite slide because it's basically a management to English dictionary. The material takes 3 of their greatest hits and runs them through a reality filter. 1. Demand is broadening across all sectors. True. But a higher base today means the 2027 year-over-year comparisons get significantly harder to beat. 2. Capacity and short lead times are our moat. True, but idle capacity still has to convert into durable market share, and time will tell if those emergency orders stick. 3. Disciplined allocation is driving a free cash flow surge, and watch this one closely. Trailing free cash flow of 6.1 billion up from 1.8 billion prior includes a fat 1.6 billion KESIASAC subsidy. Strip out the government check and that heroic surge gets a whole lot more mortal, and future credit timing will be lumpy. I'll take none of these are lies, they're just half a sentence each, and finishing the sentence is literally your job as an investor. Let's eavesdrop on how the analysts actually grilled them, because what a management team dodges is louder than what it says. The material scores 3 exchanges from the call. On CapEx and the tax credit, 4 analysts pushed the company was positive, committing to a 2 to 3 billion range and leaning high end. But ask for specific 2027 numbers, and they went full evasive, punting the whole thing to some future capital management day. On data center, 3 analysts pushed, the answer landed neutral. The engineering held up, but they refused to guide long-term growth or structural margin impact. On pricing power, 3 analysts pushed, and here, credit where it's due, refreshingly honest, they confirmed hikes started but admitted zero material impact this quarter. So the pattern our red pulls out, they'll tell the story all day long, but the second you want a hard 2027 figure, the mic mysteriously cuts out. Alright, sarcasm aside, cautious hat on, because the material flags 4 warning lights and every one of them deserves respect. First, the high base trap. A broad recovery now means brutally high comparisons in 2027, and some natural deceleration is just baked in. Second, pricing lag. Near-term margins lean entirely on factory utilization, and those pricing moves will not rescue this quarter. Third, capex pressure. Management is leaning toward the high end $3 billion of spending to lock in future capacity, and that's an anchor on near-term free cash flow. Fourth, and this is the big one, the valuation ceiling. The stock is up 70% year to date. At these multiples, any demand normalization hands you asymmetric downside, way more room to drop than to pop. The line the material lands on is one to frame on your wall. A good company is not the same thing as a good entry point. That single sentence is the whole fight over this stock. Now let's think a level past the quarter to what actually decides the future valuation. The material stands it on 3 pillars, and I want each one in your head. Pillar 1, turning capacity into market share. Can they use those short lead times to permanently poach customers, the moat flipping from defense to offense? Pillar 2, pricing realization. Whether they can actually enforce hikes in late 2027 sets the ceiling on gross margin. Pillar 3, 800V actualization, turning that data center story from a theme into hard, reported revenue. And here's the synthesis I genuinely like. The market's whole argument has officially moved. It used to be, is this recovery even real? And that one's settled now, yes it is. Now it's how long does it run and how much share can they steal? I'll take that's a much healthier debate. But notice what it means, the easy money, the recovery doubt money, has probably already been made. Last slide, and this one's your homework, the exact dials to keep on your screen. On volume and demand, watch whether the auto inflection keeps running, how fast industrial closes that gap to the 2022 peak, and lead times and backlog duration. On capital allocation, watch capex tracking against that $3 billion high end, the free cash flow path from a $20 billion framework down toward $8 to $9 billion, and how predictable those CAPEX and tax credit subsidies really are. On margin and pricing, watch the gross margin fall through, where the company targets 70 to 85% excluding depreciation and any measurable pricing contribution by the fourth quarter. And on strategy, watch for real market share proof after the 2026, the new CFO Julie next financial style, and progress on the Silicon Labs deal in the second half of 2027. Keep those lit, and you'll always know whether this thesis is holding or quietly cracking. Alright, last thing, radar always leaves you a light. Weigh the whole deck and the business genuinely earns respect, a broad cycle, real utilization, driven margins, a moat you can measure in weeks, not adjectives. That's a lot of good news, and I'm not going to pretend otherwise. But the stock has already run 70% this year, and the material's own warning keeps echoing. A good company is not a good entry point. So I'm calling this one yellow. It's not a knock on the business. It's the opposite. It's that at this price the good news is already in and the 2027 risks are not. Here's my caveat up front so you can hold me to it. If they turn that idle capacity into durable market share and hold these margins next quarter, I flip to green. But if demand normalizes while the stock sits at these multiples, this one slides toward red in a hurry. Right now, it's yellow. We're watching, we're not chasing. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.